Hey guys, Dave Keller here with Market Misbehavior. There's no doubt that the equity markets have been on a tear since the low in late September, early October, with the S&P and the Nasdaq having an incredibly strong November, as pushing the S&P 500 above its 200-day moving average for the first time since April. Today, we're going to talk about a key trend line that comes in right around the 4,100 level, which indeed is the one trend line to rule them all. So there's no denying we've seen a lot of strength in the equity markets, particularly in the short term. I've been calling this rally from October to early December as a bear market rally. And trust me, I've had plenty of pushback on social media and from our viewers for continuing to label it a bear market rally. But when I look at things like the 200-day moving average and the trend line I'm about to show you here in today's video, you'll see why I feel like it's still fair to describe it as a bear market rally until certain hurdles, certain thresholds can be eclipsed. And I think we're very near one of those, with the S&P 4,100 level being really important. Trend lines can be a great way of tracking and really defining the scope and the slope of a trend. And when the trend line breaks, it tells you that something might be different, what I call a change of character on the chart. Before we get to the chart, if you like this sort of thinking about investor decision-making, behavioral finance, and technical analysis, won't you subscribe to my channel? Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below the video if you could. Let me know, do you agree with this assessment that a break above 4,100 means we hit 4,300 before year end? Or do you agree with the idea that instead that we will fail here at the 4,100 level and go to retest the lows, or at least down to 3,800 and beyond? Let me know in the comments. Let's get to the chart. All right, so here's my daily chart of the S&P 500 going back for the last year, and I'll apologize for a very noisy chart with a lot of annotations. You know, when I share charts on YouTube and with my viewers at StockCharts TV, I like to keep them relatively clean because I want to focus on the markets themselves and focus on the price action. But in reality, I always tell people to treat your charts not as a painting that you would frame and hang on the wall, but as a notebook, right? As a workbook, as an ongoing conversation you have with the market. So this really, the S&P chart that I'm showing here today really is a representation of what a lot of my charts look like. And they usually have charts in my own process. And they also usually have a lot more words on there. I put comments and notes with different key points because it can help me. I like to look at percent movements on key rallies and key sell-offs to try to put the current movement into proper context. So make sure you are applying annotations to your tools, whether you're using StockCharts, whatever platform of choice that you use. So here's what's happened. I've described this market run from the October low to where we're at in early December as a bear market rally. And I've done that because while the strength in the short term has certainly been impressive, the breadth conditions have certainly improved. If you look back in late September, I think it was single digits percent of the S&P 500 members above their 50-day. Now it's up to over 90%. There's over 65% of S&P members above their 200-day. Those are big numbers, and certainly recognizing the broad advance that we've seen. But it's not been enough to tip the needle, in my opinion, more toward a full-on bull market trend. It still feels very much like a bear market rally. And part of it is because we haven't gotten above key levels of resistance. Now, one by one, we have faced those levels off the low, and granted, we have eclipsed them. So the S&P's first objective, I would argue, taking the August high and the October low, would be a 38.2% retracement level around 38.10. We eclipsed that in mid-October. Again, sold off below it, but then once again gapped above it here the second week in November. Next level is 4,000. That's actually a Fibonacci level from a couple different measurements. If you take that same framework of August highs to October low, 4,000 is a 61.8% retracement of the way up. 4,000 is also a 38.2% retracement of the entire 2022 sell-off from the January 2022 high to the October 2022 low. 4,000 represents 38.2% of the way back up. So getting above 4,000 was pretty important. That's why I had this blue shaded area on my chart for quite some time now, because that was identified as a clear upside target. Now, the market rallied up to that level third week in November, stalled out there for a little while. And just this week on Powell's press conference on Wednesday, powered above the 200-day to close above it for the first time since early April. We then had a bit of a follow-through day, although Thursday's session was a bit of a short-term pullback. from Wednesday's close. Overall, we're still above the 200-day moving average, and the intraday low was right at the 200-day. So we literally traded down to the 200-day and bounced back above there. That's how important that trend gauge is for a lot of investors. So first things first, staying above the 200-day moving average, I would argue, is incredibly important. Not all indexes have done that yet, and the more that do so, the more bullish that this market appears. But what I want to talk about today is this trend line, this dashed green line. It basically connects the January 2022 all-time high for the S&P 500. That connects pretty well with the late March peak, connects very well with the August 2022 peak, and that actually lines up very well with today, Thursday, December 1st, intraday high. We traded literally right up to 4,100 and came off. So this trend line literally tracks the downtrend in 2022. And when I first learned technical analysis and was looking at trend lines, I was taught once is chance, twice is coincidence, 3 times is a pattern. The idea is if you connect a line with 2 points, there's not a lot of validation to that. But if you validate it with a third test that confirms that same trend, what you've learned is you really have a good visual representation of the pace of the downtrend, or in an uptrend, connecting a trend line using the lows would tell you the pace of the uptrend. So what this tells me, when we've confirmed it a number of times, is this is a very valid representation of the pace of the downtrend in 2022. That means this 4,100 level where we're at right now is incredibly important, because if we are unable to break above that trend line, that tells you that instead of being a new bull market phase, this is more of a bear market rally, similar to what we saw in August, stalling out at the previous highs or the previous trend channel. And this is literally a downtrend channel. This was the 4th quarter rally before a resumption of the downtrend, most likely going into the beginning of next year. However, if we're able to power above this trend line for the first time in 2022, that would tell me that this is most likely a change of character. We will have eclipsed all of the key levels of resistance that we've identified in the last 4 to 6 weeks. That tells me that I can't call this a bear market rally anymore. I have to call it something different, and really the beginning of a more constructive price action in the S&P. So what would happen if we would get above 4,100? Well, I would be looking to the next level up. And that's why my show on StockCharts TV is called The Final Bar. The discipline is, or the idea is, look at the final bar, the current price bar, and then look to the left. What levels stand out as you look to the left? What highs are higher and lows are lower than the current level? That gives you a good idea of potential support and resistance levels. So 4,300 would be the August peak. That would also represent a 61.8% retracement of the way back up to the January high. So I would be amazed if we got above 4,300 or 4,325, because I think that represents a clear upside objective. And December is seasonally the strongest month of the year, particularly in a midterm election year. December actually tends to be pretty strong. So I wouldn't be surprised if we do break above that trend line, in which case I think that would kick into an upside objective of 4,300. What happens if we fail at this trend line, which is also very much a distinct possibility? Well, then, same thing. You have to look to the left and see what levels are important. 3,800 would be the 50-day moving average, and also is back to that key Fibonacci level that we talked about earlier. Below that, you're talking about a new low, right? 3,600, maybe a little bit further to the downside. But first things first, you'd hit one of those key levels of support that stand out on this chart. Now, I've mentioned the word stall a number of times, and if you've heard me give presentation or if you watched me speak before, I often bring lessons from aviation into investing. I'm a student pilot. I've spent many hours learning to fly a Cessna 172R. I still have very much to learn. I've enjoyed so much talking with successful investors that are also successful pilots, because I feel like there are a lot of similarities in how we try to minimize the emotional impact of our decisions, or the emotional influence of our decisions, to be more clear. So when I call this a stall, I'll share with you a quick story from aviation. It's called a power on stall. There are 2 different ways you can stall an airplane. And stalling does not mean the engine runs out of gas. That's actually called an engine cutout, or an engine failure. A stall is where you literally create the conditions where the plane's wings can no longer produce lift, right? The way that you go up on an airplane is when you push forward, when you have power going that way, there's lift that is produced by the airflow over the wings, over the surface. And as a result, the plane goes up in the air. What happens when you are trying to take off, and if you do too steep of an angle, it's called a power on stall. You are at full power, throttle all the way in. You are trying to climb, but by putting an angle too high, you all of a sudden prevent the wings from producing lift. You're at too steep of an angle. And all of a sudden what happens is, I'll tell you what happens is you panic. The first time you do one, it is, my palms are sweating just thinking about my experiences of power on stalls. They are very unsettling, and you learn to do them because you need to learn how to recover from stalls, right? The whole goal is, if you experience the conditions leading into a power on stall, you need to alleviate those conditions as quickly as possible. And what you want to do is just maintain the angle that allows the wings to produce lift and allows you to continue the climb, because power on stalls usually happen right after takeoff. And if the plane goes down right after takeoff, the ground is not far enough away from the plane, it often can end pretty poorly. So usually go way up in the air to practice power on stalls and power off stalls, which are more common during landing phases. And you learn the sounds and the sensation that the plane experiences when you're near the stall, so that you can alleviate the conditions as quickly as possible. So this market coming off the October lows looks very much like what I would call a power on stall, right? You have a full throttle. We're taking off from the runway, which is sort of the October lows. And you can see a bit of a stall here in early November. You can see another one here in mid-November. And that's when, again, we're trying to go up. We have a certain pace, and all of a sudden, it's called a buffeting, right? Where the nose starts to chop around, and the plane all of a sudden feels like it doesn't want to go up anymore. That's the beginning of a power on stall. Now, one of two things can happen. If you are able to correct for that stall, what happens is you quickly regain the ability to produce lift, and you may lose a little bit of altitude, but overall the trend continues to the upside, and you continue to gain altitude, and things recover very well. If you don't recover correctly and do the worst thing you can do is actually pull back. I've tried it. It's not good, because what happens is you in the short term, you kind of gain a little more altitude, but what happens soon after is the nose usually goes way down, because you've done what's called a secondary stall. You've actually stalled the plane again, and all of a sudden the nose really goes down. You can lose a lot of altitude very quickly. Right now, as we test this trendline resistance, I would argue the market has gone through a power on stall. We are just at the point where we're trying to recover correctly. We've had that choppy period in November, and now we're potentially regaining altitude, powering us through a successful takeoff into year end. And again, I think with a reasonable upside objective of 4,300 for the S&P. But if we are not able to recover well from that power on stall and the nose goes down, you can lose altitude very quickly. And I think if and when investors realize that that trend line is going to hold, realize that we don't break above the 200-day moving average and continue, but actually run out of upside momentum, that's when we can lose altitude very quickly. That's when I feel like the 50-day moving average is a very reasonable downside target en route to potential further lows at the beginning of next year. So that is a rundown of the S&P 500 chart using the trend line analysis, the one trend line to rule them all, but also the metaphor of a power on stall, which I think is a very realistic illustration of what we experienced right now. Do you agree with that idea that we've experienced a power on stall? And do you feel like we will regain altitude? If so, what is your upside objective? Do you think 4,300 is reasonable or something different? Let me know in the comments below. For Market Misbehavior, I'm Dave Keller. Be well, stay safe. Talk to you again soon.